All right. Hello, everybody. It is Wednesday, so we are coming to you live from Investing Education Academy. And today we have a very good topic. It's the middle of the year, and some of you all are wondering what's going on in the stock market. We're here to talk about it. And the stock market, as most of you all know, is highly affected, has been affected, say highly, with the cryptocurrency marketplace. So today is going to be a general conversation between Leon and I, talking about where we are mid-year, some things you should be thinking about, some of the things you might want to avoid, some of the things you probably want to pay more attention to. While Leon tells you why we chose that topic, I'm going to do what I always do, a little bit of housekeeping.
Yeah, so we're in June now, mid-year. The market has been, the stock market has been relatively tame-ish. Let me take that back. The market's actually up quite nicely for the year. And that, which to me is that I actually found this to be kind of odd because we're in a crazy year right now with the pandemic, with rates, and then the cryptocurrency market doing what it does and it's affected housing market. So I'm just going to go over just kind of some quick stats of where we are with the market. And then I'm going to touch on a topic, the Federal Reserve that happened today, which is really big regarding the market. So year to date, through today, the general stock market, the S&P 500 is up 14%. And the NASDAQ 100, which tracks essentially the tech side of the market, is up 10%. Now, that's actually flipped because typically tech leads the market. Tech typically leads the market higher. But if tech is down this year, and this goes back to that whole discussion about like how this market this year is weird. And the reason tech is a little down from the stock market is because of interest rates. And as we talked about in many lives before, that interest rates when interest rates rise, they negatively affect tech stocks in particular, just because typically tech earnings or growth companies, their earnings come out, a couple of years out. And when big money sees, okay, I can go into a bond and get 2.5%, 3%, 4% right now, versus wait, a couple of years for this company to make money, they're going to pull money out of the stock market and put it into bonds. So,
and real quick, so that's the inverse relationship between the two. If any of you all, just need to understand the way an inverse relationship works, when one is moving forward, the other one is moving back, or in this case, when one is normally doing better, the other is quote unquote doing worse. But as we talk about the inverse relationship of the two, understand that everything has a season in investing, and seasons come, seasons go, and that's what we're going to dig into a lot of stuff today really quickly. But so if you have questions, I just want to say, if anybody has questions as we dig into this topic about maybe like what your portfolio is doing mid-year, number one, I hope you're an Investing Education Academy member, because we just held a hot seat last Saturday where one of our members showed us a $1 million plus portfolio. And when I say showed us a portfolio, he literally showed us his portfolio, like the stocks that he owns. And you can only get that information if you're, a member of Investing Education Academy. So for some of you all who are on the fence, like, what do you all really do? If you can tell me the last time you've seen somebody's a millionaire's portfolio, then I will be quiet. But if you haven't seen one recently, you should be an IEA member. It's a lot of great stuff happening. And also, spoiler, we're coming up on our 1 year anniversary. So it's right around the corner. Leon and I didn't even really realize it until we kind of looked up and said, oh my gosh, when we're looking at this, mid-year review, like this is actually our 1 year anniversary coming up. So we're going to have some deals going on. We're going to have some opportunities for you all to get memberships that, you might enjoy, just stay around, stay close by. And it's going to be a lot of things going on for, you said 2 weeks, Leon, because you and I were going back and forth, whether a week or 2 weeks.
2 weeks, yeah.
The 2 weeks around us celebrating our 1 year anniversary, there is going to be a lot of bonuses and gimmies for those freebies who and some just discounts for people in our ecosystem. So definitely stay close.
Yep. Yeah. So what happened today? So kind of back to the market now. So like I said, mid-year check-in, we're just kind of seeing where things are. Quick recap, the S&P 500 is up 14%, which is considered the general market. And then the NASDAQ, which typically tracks tech stocks, which a lot of, at least the IEA world is big into, is up 10%. And I was saying earlier, the reason, so typically tech leads the market, right? Typically the NASDAQ will be higher than the S&P 500. Right now, the NASDAQ is four points below the S&P 500, again, 14% to 10%. And the reason that is kind of what I'm talking about now, which is rates and interest rates. So the Federal Reserve came out today. So people in the investment world know this is called Fed Day, which is like the big woo. Fed Day typically moves the market. And if any of y'all you're watching today, Fed Day moved the market dramatically today. So what they came out and said was, so last year when the pandemic hit, Jerome Powell, who was the head of the Fed, he cut rates to effectively zero, right? So all interest rates that they control, which are banks and typically like credit cards, savings accounts, they cut all those basically to zero, right? And the reason they do that is because they want businesses to continue to borrow money to keep the economy afloat. Well, and at the time they had said they're not even going to look to raise rates until 2024. So they were saying 3 years out, right? And all this time, every time because they do these every couple of months, and every time he's been asked, like, what do you think about inflation? What do you think about the rising prices? He's like, oh, it's transitory. It's going to go away. It's not going to be here long. Therefore, we're looking to raise rates, 3 years out. Well, today they totally changed their mindset or what they were saying. So today came out and said that they're moving up. They're looking to raise rates 1 year earlier now. So looking to raise rates now in 2023. And he also said that the rate of inflation, how fast prices are rising, are way outpacing what they anticipate. Right. So what does this mean for the market? What this means for the market is rates are going to be going up. Interest rates are going to be going up. And as I said earlier, that's negative. That can be a short term. Well, we showed before that in years when rates rise, the stock market actually does better than average. So the stock market typically does about 10% per year. I think the years when rates rise, it does like 12 or 14%. But it's about the speed of those rates, how fast they rise. So the faster they rise, typically that's bad for the stock market in general, and really bad for tech stocks. So
Leon, real quick, we should just give a level set for people who are thinking why. Most large corporations, they deal in leveraged debt. And not only that, but a lot of large, talking billion-dollar corporations, multi-million-dollar corporations, really billion-dollar corporations. When you're talking about the cost of money, the more money costs, the more it cuts into profits. The more it cuts into profits, the less stock or shareholders like it. The less shareholders like it, sometimes they don't support the company as well. Also, cost of goods sold can go up. So, all these things, because, when we're talking, we might go fast. You might think like, well, why does interest rates rising even matter? And so as we talk about it, just know cost of goods sold, the cost of money more than anything else. And, you have some of these competing investments that if they become more attractive, money moves away from the market sometimes, not all the time, sometimes money moves away from the market to go into competing investments because, hedge fund owners or whoever it might be feels like, oh, I can get, a higher rate of return with less risk. And so they'll move money out of the market, which can drive the market down a little bit.
Yeah, that's what really hits the market when rates rise for the stock market is that, we're not even talking about savings accounts. So things like CDs, things like CDs, bonds, money market funds, their rates go up, right? And these are really these like CDs, bonds, and money market funds. They are way less risky than the stock market, right? So now, if you can go into a bond or a money market and get 3.5%, 4%, pretty much. I mean, nothing's outside the bonds that are done by the government. Nothing's guaranteed, but it's a pretty safe bet. If you go to a money market, you're going to get that 3 to 4% return. Versus the stock market, which we all know can be very volatile, right? I mean, it can be up, 4% one day, it can be down 3%. Like it can just be really, really volatile. So big money, people that have billions and billions of dollars, they're like, no, I'm gonna take my 10 billion and put it on this 3.5% and let it sit. So they're gonna pull that money out of the stock market and put it into this safer asset. Right now, rates are really around 1%. So the stock market is really kind of the only game in town. But as these rates rise, alternative investments become more attractive to big money, and then that money can move out of the stock market. Doesn't mean the stock market is gonna crash or anything, but you will get a lot of volatility. You will get a lot of movement up and down. But as I said, when rates rise, on average, the stock market actually does better because typically when rates are rising, it usually means the economy is strong, right? So like inflation. So inflation is a bad thing. We all hate it. But when you're coming out of something after a recession, it's actually a good thing because that means there's more demand in the economy from consumers like us chasing goods. So we're out there spending our money. So it's driving up prices. That's a good thing for the economy because it means that there's demand. But it hurts our wallets because again, things are way out of price. But generally, the economy is good. So the Fed coming out today saying they're looking to raise rates a year earlier, and inflation is rising faster than they anticipated. So what happened today? The market imploded. Well, not saying imploded. It dropped like, I don't know, 1 or 2%, like that, like right about 2:00 when the notes came out.
Yeah, and that's in one day.
Yeah, it's one. Yeah, I mean, this is literally about 1 hour, and then about an hour later, it came back. So again, that's what I said. You're going to see a lot of volatility, a lot of gyrations around this topic of interest rates.
Did you say gyrations?
I said gyrations. Yes, you can see a lot of gyrations around the stock market, the way it's moving, especially around rates. But just know that the Fed raising interest rates and inflation happening right now, while it sucks short term, long term it's actually really, really good for the economy. So so your portfolios are going to see a lot of movement, especially if you're heavy in tech. Like I know a lot of people in the IEA ecosystem are. We're going to see probably a lot more volatility than a lot of people that aren't in tech. But if you're in tech, you're going to see, we're going to see a lot more volatility than normal. But it's not, again, it's not a bad thing. The company's fundamentals haven't changed. They're still solid companies. It's just this whole thing with interest rates are going to, kind of add gyrations to the market.
Boy, you between that and dry powder and all this.
Dry powder.
As you all think about, what do I do during this time? Do I sell? Do I buy more? Do I have any dry powder laying around to invest in? Do I have any curious money, risk capital? These are all questions that we would urge you to go over to our Facebook group. And for those of you all who aren't members, there is going to be some really great conversations happening inside of our Facebook Investing Education Academy group around these topics. And, you can kind of come and put a toe in the water to see if Investing Education Academy is the platform for you. But there's going to be a lot of conversations about what do I do from here. So, we wanted to kind of leave you off by saying, number one, the sky is not falling. This is not the moment where you're like, okay, I'm liquidating everything. I believe personally that, in times where, you start to see interest rates hike up, it does test the integrity of some of the overvaluated smaller companies who have been trading really high. The market tends to weed out some of those people when interest rates start to tick up. So that's just my personal thought. Leon, do you have any thoughts about that?
No, I mean, and that's a fact. Like, since rates have been rising, a lot of these high valued stocks, these high valued tech stocks, that really their earnings don't justify their valuation, got hammered from February through April. I mean, a lot of us know tech was down big, and it was hurting a lot of our portfolios. Now things are kind of coming back, but I mean, because as rates are rising, again, that hurts tech, and it really hurts high value tech. And like Brent, I've always said, I know in my portfolio, my biggest loser right now is ticker symbol AI. The company C3.ai. When I bought it, when around the same time we bought it, I don't know what his PE was, but it was very, very highly valued relative to.
I think it was like 340.
340 PE.
No, what?
No. When I first bought it was like 140 something.
290. I got it high, and I knew it when I got it, and I was like,
Right, yeah. But based on its PE, around the time we bought it, it was high. But we knew it was high. Like we were like, okay, it's high value stock. We're in for the long haul. We know it's a growth stock.
And we bought it close to the this to be noted. We bought it very close to the IPO.
Yeah, right. Oh. Yes. Yeah. And as we said before in the past, typically when companies come out in IPO, they'll kind of rise, they'll come back down, and they'll move back up later. But so we bought it relatively early from what we typically do. But the biggest thing again was interest rates. As interest rates rise, that really, and then when I say rise, interest rates are rising at a clip, one of the fastest clips in history of recording interest rates rising. So the market really didn't know what the hell to do, and it freaked out and it sold off a lot of tech stocks. So so just know that going forward. I mean, as I said right now, so just reset. The market right now is doing great. It's up 14% year to date from the beginning of the year to now. Tech is up 10%. So while it may feel like our portfolios have taken a hit recently, generally they haven't, because we're still up for the year. And then if you bought last year, you're up even 2 or 3 times as much. So so things are bumpy, but things are overall good. And if you have any, as I say, dry powder, any stock that you're following that that you like, look to buy on pullbacks.
Because you'll see a lot of gyrations between now and then.
A lot of gyrations. I like gyrations. Yes.
So what we're going to do something a little different, if it's cool with you, Lee. Instead of giving you all our stock picks right now, we're going to post them into the Facebook group tomorrow. And what we're trying to do is just drive activity to our Facebook group. And so, you know, we really want to increase the people in there talking about what they're buying, selling, asking questions, because that's going to make the group richer. And also it gives us a more intimate setting to talk to you all. So if we can do that, it's a little bit different. We're coming on our 1 year anniversary. We might be switching some things up. But you know, if you are interested in our stock picks, tomorrow, before close of business tomorrow, let's say, go over to our Facebook group and you'll see our stock picks. And you know, if I'm missing anything else, I want to say that for those of you all who have been interested in joining our cryptocurrency group, we are now at 14 members. So we have about 10 or 11 slots left. So we have 11 slots left. Don't wait, because, you know, right now it's $200 a month to join. Fast moving group. But when we reach our 25 member limit, the next cohort is going to be $300 per month. So, and we're getting some really good information there. The conversations are awesome. We're getting new members pretty frequently. So if you're thinking about it, stop thinking about it. Go ahead and let us know that you want to join, and we will sign you up. For those who want to join Investing Education Academy, which we had a new member sign up before this live, you know, please go to IEAmembers.com. You can sign up, choose the membership platform that makes the most sense for you. And one thing you should note, if you become a IEA Panther, you get access to the IEA Crypto Bulls and everything else that we do. We invest together. We buy land. We do a lot of different things. We are invested in, we're probably part owners in at least 7 different companies now. And, you know, as these things mature, the fruits of our labor is going to shine through. And I really hope you're there for the ride. But if you aren't, you know, we just don't want anybody to say they didn't know. And that's the biggest thing. Like, we don't want anybody saying they didn't know. So, Leon, if I'm missing anything, I was going to tell everybody goodbye. But am I missing anything?
No, that was pretty much it. And I'll just say, you know, being that we're, you know, in June, mid-year and midway, halfway through the year, you know, take time to look at your portfolio, check out, you know, the stocks that maybe are underperforming, stocks maybe you want to trade out of, maybe sell half of some to get into something else. Just do kind of an evaluation of your portfolio, since we're now, you know, halfway through the year, you know, kind of set yourself up for the next 6 months going to the end of the year.
Yep. And for everybody who's checking out the IEA podcast out in Belgium, Spain, Egypt, Canada, Hong Kong, we really want to thank you all for listening. The growth it couldn't happen without you all supporting us and sending this podcast to your friends. And I'm glad that I'm seeing enough value to share it with your friends, because the podcast is definitely growing. We're getting over 600 original downloads of our podcast per month now. And so to have 600 new people, you know, downloading our podcast is really awesome. So, you know, thank you for your support, and everybody, will see you all next Wednesday, 9:00.
And remember, check out the Facebook, our Facebook group. Go to on Facebook, search Investing Education Academy. And then in there, we'll post our picks for this week.
All right. Have a good day, everybody.